Welcome back to the Deep Dive. It is Monday morning, January 19th, 2026. And, if you're sitting there with your coffee, maybe looking at your portfolio, you might be thinking things look, well, pretty decent.
Deceptively calm, yeah.
Exactly. It feels safe, even. But the source we're looking at today, the Market Situation Report from Pheneck, is basically screaming at us not to get comfortable.
Not at all. In fact, they have a very specific and, honestly, kind of a terrifying metaphor for where we are right now.
They call it the tiger's cage.
It's a vivid image, isn't it? It certainly grabs your attention faster than a spreadsheet.
It really does. I mean, usually in this business, we're talking about bulls and bears.
Yeah.
Everyone knows that drill.
Drills charge, bear swipe.
But a tiger, that feels, I don't know, different. So help us out here. Why are we stepping into a cage with a tiger, and what does that mean for your money this week?
Well, think about the behavior, right? A bear is. It's heavy, it mauls, it's obvious. You see a bear coming. A tiger stalks, it's quiet, it moves through the grass, you don't hear a thing, and then suddenly it's just explosive, sudden violence.
So the quiet isn't safety. The quiet is actually the trap.
That is the core thesis of this report. Pheneck is arguing that the market has lured everyone into this sense of complacency with all this low-volatility chop. But we are essentially trapped, and the cage door is quietly locking behind us.
Okay, so there's a massive convergence happening, a collision of, technicals and macro events.
Exactly. And unlike those general market outlooks where an analyst just says, be careful in Q1, this is hyper-specific, we're talking about a volatility window that opens, right now.
Right, let's get specific. We aren't talking sometime soon. The report circled a very particular set of days.
Next week. Specifically, January 26th through January 30th.
That's the danger zone.
That's when the tiger is expected to pounce.
Okay, a 5-day window where things get real.
Okay.
Let's unpack the why. What makes this week so radioactive?
It's a trifecta of chaos. You have 3 distinct forces all hitting the tape at the exact same moment.
Force number 1.
The Federal Reserve. We have the FOMC meeting on tap.
Which is always a coin toss. I mean, even if rates stay the same, just the language Powell uses can tank the market in 5 minutes.
Precisely. It sets the tone. But the Fed meeting is really just the backdrop this time. Force number 2 is earnings. But not just earnings season. We are facing an absolute deluge of reports from the biggest names.
We're talking about the giants.
Apple, Microsoft, Amazon, Meta, Tesla, Google, Netflix.
All in the same week. It just seems like poor scheduling.
All of them. Crammed into this one window. The source points out these names represent something like, 40 to 45% of the entire NASDAQ-Q's weighting?
That is incredible leverage for a single week. So almost half the index's value is basically up in the air at the same time the Fed is deciding the cost of money.
It's a recipe for liquidity whiplash. But then you have the third factor, and I have to say, this is the curveball that I think very few people are pricing in right now.
I think I know what you're going to say. I had to read this part of the report twice because I thought it was a typo. Greenland. We are worrying about Greenland now. How does an ice sheet factor into a stock market crash?
It sounds totally obscure, I know. But you have to look at the geopolitical chessboard. The report highlights the Trump administration's renewed, very aggressive interest in Greenland.
Right.
It's not just about buying an island, it's strategic. It's about the Arctic, it's about rare earth minerals, military projection, and the source links this directly to escalating tariff tensions with Europe.
So it's a proxy for a trade war. It's not about the ice, it's about the friction.
Exactly. It's diplomatic friction. So picture the scene. Fed's messing with rates, half the stock market's reporting, and suddenly a headline about a diplomatic crisis over Greenland flashes across the screen.
That's the tiger's cage. You just don't know where the attack is coming from.
It's a lot of noise all at once.
So how is the smart money reacting? Are they running for the exits already?
Not yet. And that's that stalking phase we talked about.
Right.
I mean, the NASDAQ-Q's been consolidating for 7 weeks, just chopping sideways.
Right.
But the report does note a very subtle signal. Look at the banking sector. The XLF ETF.
The financials.
Right. While tech is sort of asleep, the banks are signaling that liquidity is starting to flow back into the system. It's like a whisper before the shout.
So a bigger move is coming later in the year.
Yes, but we have to survive the cage first.
Okay, survival is the priority. Let's look at the charts, because the report spends a lot of time on these so-called technical anomalies. And there's one phrase that sounds like a mystery novel title: the wickless candle.
It does sound dramatic, doesn't it?
A mystery of the wickless candle. But this is critical for our crypto listeners, Bitcoin and Ethereum. break this down for us. What is a wickless candle, and why should I be so terrified of it?
Okay, let's go back to basics for a second. Visualize a candlestick on a chart. You've got the thick body.
That's the open and the close.
Right, and then you have the thin lines sticking out the top and bottom. Those are the wicks.
And the wicks are the exploration, right? The price went down here, didn't like it, buyers came in, and it bounced back up.
Exactly. It's price discovery. A bottom wick means the market tested that level and said, okay, the fair price is higher than this. It validates support. I mean, 99% of candles have wicks. It's natural market breathing. Inhale, exhale.
Okay, so wicks are normal. Wicks are healthy.
But right now, if you pull up the yearly and the quarterly charts for Bitcoin, there is no bottom wick.
Meaning the price just opened on January 1st and went straight up.
Straight up. Immediate expansion. Not even a penny of downside testing. In the world of TA, for an asset like Bitcoin, that is highly suspicious. The source calls it unfinished business.
It feels
artificial.
It feels manipulated.
Yeah.
Just fragile.
Yeah.
It implies the foundation hasn't been tested. And the market has a memory. It usually likes to return to the scene of the crime to sort out these flat opens.
It needs to go back down, test that price, create the wick, and then it can go higher. Yes, that's how you sustain a rally.
So even though Bitcoin's rallying now, it's in the 90,000s, this report is basically viewing all this strength as a trap.
A counter-trend rally, yes. They believe this whole push right now is just forming the upper wick before the real drop comes. And they're incredibly specific about the target. They want to see price return to the yearly open at $87,648.
Wow. So if you're sitting at, say, 94,000, the expectation is a flush all the way down to 87 just to, what, fix the chart?
Yes. And here's the danger for the retail trader. We're sitting just below a key resistance level at $98,200. The report calls it dicey.
I see the trap.
The trap is we tap 98K, everyone gets excited about breaking 100K, and then the floor just falls out to go repair that candle way down at the bottom.
That is just psychological warfare. It's like building a skyscraper, but then realizing you forgot to pour the concrete for the basement.
That is the perfect analogy. You have to tear it down to the ground to fix the foundation. And if you think Bitcoin looks precarious, Ethereum is. Well, it's essentially in the basement already, but with a shovel.
Yeah, the report was not kind to Ethereum. Right. I think I saw the word snail used. That's never a compliment in finance.
Snail and range bound. I mean, Ethereum has been trapped in this structural range for 4 or 5 years.
Yeah.
Not trending. And it has the same wickless problem as Bitcoin, but it's even more mathematically absurd.
How so?
The source notes there is only a $1 difference between the open price and the low.
A $1 difference on a multi-thousand-dollar asset. That's a rounding error.
It's a massive inefficiency. And this is where the snail thing comes in. The report identifies a specific pricing gap on the Coinbase exchange. And this gap is dragging the price of Ethereum like a snail up toward resistance.
And that resistance is at?
$3,447.
So it's grinding up, which usually feels good.
Not in this context. The report argues this is a giant short signal. Institutional sellers are just sitting at $3,447 like snipers. They're waiting for retail to get FOMO, provide them the exit liquidity, and then wham, they push it right back down.
To repair the structure and the target for ETH.
$2,967. That's the magic number, the flat open. So for crypto listeners, the takeaway is pretty stark. Don't chase the green right now. The structure is broken.
Fascinating. So crypto is broken and needs repair. Let's pivot to the traditional markets. We talked about the NASDAQ. Is the same wickless thing happening there, or is it a different beast entirely?
It's a different mechanism, but the same predatory intent. The view here is that nothing the NASDAQ is doing right now is random. The report calls it a calculated liquidity hunt.
I love that phrasing. It makes the market sound like a living organism.
In the age of high-frequency trading, it effectively is. It's an algorithm. The market isn't grinding higher because the economy is booming. It's moving higher to fill a specific open inefficiency, a gap between 25,762 and 25,972.
Okay, so the algo sees a hole around 25,900 and says, I must fill this.
Exactly. It just magnets up to it. But here's the danger, and this gets a bit technical. The report identifies a pattern haunting the index called the inside 2-week candle failure.
That is a mouthful. What does that mean in plain English?
Okay, picture a candle on a chart that fits entirely inside the high and low of the candle that came before it.
So, indecision, compression.
Right, like a coiled spring. A failure means the market tried to break out of that coil and just couldn't. It implies the current move is unstable.
Or coiled up but fragile.
Exactly. So the prediction is Once that upside gap at 25,972 is tagged, once the algorithm gets its lunch, the market is primed to reverse hard. It's going to attack the downside vacuums.
Vacuums. This report loves its physics metaphors.
It does. A vacuum is empty space left behind during a rapid rally. The market hates them. The primary downside target is a big gap between 24,647 and 24,921.
So same playbook as crypto. Move up a little to fill a gap, trap the bulls, then drop hard to fill the gaps below.
That's the base case.
Is there any scenario where this is just wrong? I mean, what if Apple and Amazon just crush earnings?
To be fair, they do offer an invalidation level. They're not dogmatic. If that 2-week candle manages to close above 25,835, then the bearish thesis is dead.
That's the line in the sand.
That's the line. If we close above it, you could see a melt up to 29,000. But the report is clear. That is the low probability outcome.
All right. So we have short-term chaos, technical repairs needed. I want to zoom out, though. The report puts a big red circle on a specific date later this year, May 15th, 2026. Why is that date so important?
This is where we shift from the technicals to heavy macro. May 15th is marked as the pivot.
The pivot.
That is the date a new Federal Reserve governor is expected to take office. And the source predicts this marks an official regime change. We move from quantitative tightening,
taking money out of the system,
to quantitative easing,
opening the faucets.
The liquidity flood. The source explicitly says Bitcoin will be the primary beneficiary of this. Historically, when the Fed prints, hard assets fly.
But there's always a but.
A huge but. We have to survive until May. And the path between now and then is not a straight line.
Which brings us to my favorite part of the report, just for the human drama of it. The potential conflict between Fed Chair Powell and the Trump administration. They actually call it the middle finger scenario.
They did. It's a colorful way to describe a very real institutional tension. I mean, think about the psychology here. Powell's term is ending. There's friction with the administration.
Right.
So the source speculates. What if the market is pricing in this smooth transition to easy money in May, but Powell decides to assert his independence one last time?
You mean go rogue?
Maybe not rogue, but rigid. He might keep rates higher for longer or pull some policy lever the market isn't expecting just to tarnish the legacy of the incoming guard or just to prove the Fed can't be bullied.
A scorched earth exit. You want lower rates? Fine, but I'm going to make you sweat for them first.
Potentially. The report calls it erratic behavior. The point is, don't assume the transition will be smooth. Powell might decide to go out with a bang, not a whimper.
That adds a whole layer of risk you can't really chart. Okay, let's talk sectors. This report points to a massive bubble in one area and a super cycle in another. Let's start with a warning. Silver.
Yeah. If you're a silver bug, you might want to cover your ears. The report is very stern. Silver is in a fully overinflated bubble.
How are they defining that? Is it just a feeling?
No, it's data. They're looking at the quarterly RSI, the Relative Strength Index.
Which measures momentum.
Right. It's sitting at 90 to 95. For context, anything over 70 is usually overbought. 90 to 95 is a historical extreme. It basically means there are no buyers left. Everyone who wanted silver already has it.
And when the music stops?
There are no chairs. The quote from the source is brutal. Silver bubbles do not consolidate, they collapse. They are warning of a potential 35% drop in a single week.
Ouch. 35% in a week. That wipes out a year of gains.
It's happened before at these RSI levels. The advice is clear. Take chips off the table.
Okay, noted. Avoid the silver bubble. But where's the money going? The report mentions space.
This is the supercycle, the antithesis of the silver trade. We are looking at the space sector.
And this is all driven by, let me guess, Musk.
The Musk factor. You can't ignore it. The report anticipates the SpaceX IPO later this year. They argue that Elon Musk is going to drive a narrative frenzy to pump valuations toward $1 trillion.
But you can't buy SpaceX stock yet. It's private.
Exactly. So that money flows into the ecosystem. It's a sympathy play. The report specifically highlights Intuitive Machines, ticker LUNR.
LUNR.
They note it's in a massive consolidation pattern that's ready to break out. As the SpaceX IPO hype builds, money will look for the next best thing. Stocks like LUNR are expected to run through the roof on that narrative alone.
So sell the shiny metal, buy the rocket ships. It sounds like sci-fi, but that's the market we're in.
Narratives drive price.
All right, we've covered a lot of high-level theory. Let's give our listeners something concrete. The report offered 2 specific tactical trades for this earnings week. Let's break them down. First up, Apple.
Apple. AAPL. Now, despite some recent weakness, the source sees a tactical long here.
Even with all the tiger's cage volatility.
Yes, but it's a sniper shot, not a buy and hold. They're looking for a mean reversion. The strategy is to wait for the price to correct down to $252.
Why? $252 specifically?
It's another gap fill, an inefficiency on the chart. The idea is that price will magnet down to $252, fill the order book, and then bounce. But, and this is crucial, you need a strict stop loss.
Where's the line in the sand on that one?
$244. If it drops below that, the thesis is broken, the gap didn't hold, and you get out immediately.
Got it. Buy at 252, bail at 244, short and sharp. What's the second trade?
This one is for Axum Therapeutics, ticker AXSM.
Okay, biotech, always a roller coaster. What's the setup?
It's a technical pattern, a double inside 2-week candle.
We're back to the inside candles.
We are. This means extreme compression. Imagine holding a beach ball underwater. The potential energy just builds and builds. The moment you let go, what happens?
It shoots up out of the water?
Exactly. That's what the price action is doing. It mirrors the recent breakout we saw in the USDJPY currency pair. It's coiled that tight.
So where's the entry? When do we let the beach ball go?
The report suggests going long at $177.27, with a tight stop at $170. It's a pure breakout play.
Fantastic. So we have a defensive plan for a giant like Apple and an offensive breakout plan for Axum.
It's about being precise in a messy market.
So as we wrap this up, let's synthesize this game plan. We're walking into the tiger's cage next week. If our listener takes away only 3 things, what are they?
Number 1, survive the volatility of January 26th to 30th. Don't get chewed up. Keep your position sizing small.
Right. Defense first.
Number 2, watch for the wickless repairs in crypto. If Bitcoin hits $87K and Ethereum hits $2,967, don't panic. That's not the end. It's structural repair. It's actually healthy.
And number 3.
Number 3, keep your eye on the horizon. The real liquidity flood doesn't start until after that May 15th pivot.
It's a game of patience and survival until then. You know, I can't stop thinking about that middle finger scenario.
It is the lingering question, isn't it?
It really is. I mean, we spend so much time analyzing charts and algorithms and gaps. But at the end of the day, markets are made of people. And if the most powerful man in finance, Jerome Powell, decides to go off script in his final months,
all these technical patterns we just talked about could get rewritten in an afternoon.
That's the human element of risk. The charts tell us what the crowd is doing.
But they can't always predict what one man with a grudge might do.
Something to mull over as you watch the tickers next week. The tiger is awake. Stay disciplined out there.
And keep your stops tight.
Thanks for listening to The Deep Dive. We'll see you next time.